Okay, so my name is Rhys Davies. I am a fund manager at Invesco, where I manage our two high-yield bond investment trusts. And when AJ Bell initially asked me to speak at this event, it was before most people even knew what a coronavirus was. And the focus of the event was to be how to find income, I suppose, in what had become an income-starved world. And that situation has certainly changed somewhat in the markets that I invest in, which is predominantly the high yield bond market. Um, there is much more income available today, but clearly there are also many more risks. So hopefully what I can achieve in the next 20 minutes is to give you a balanced understanding of both those opportunities and the risks that are in the high yield bond market right now. So first of all, the two investment trusts that I manage, Invesco Enhanced Income and City Merchants High Yield Trust, and I will refer to them as IP and City Merchants out of habit. And you can see their stock market tickers on this slide. Both are managed as income products, and I have included here their dividend yields. So the current dividend yield is 7.5% for IPE, 5.9% for City Merchants. So today I thought I would keep it simple and cover three areas. So high yield bonds, what they offer investors and where they can sit in your portfolio. The high yield market today and what it looks like in a COVID-19 world. And then to finish off with a quick overview of the two investment trusts that I manage at Invesco. So first of all, what am I referring to when I say a high yield bond? And I'm sure you know this, but a bond is a loan to a company or a government, and a high yield bond is defined by its rating and not by its yield. So the name high yield is often a misnomer, and especially when we have been living in this world of low yields. So it is the credit rating that determines whether we call it a high yield bond, and the credit rating is calculated by the credit rating agencies, so S&P, Moody's, using some very fancy formulas. And ultimately, the credit rating is supposed to reflect the level of credit risk in lending to that borrower. So when I buy a bond, how much risk am I taking with the borrower? And so the term high yield simply refers to any bond that is rated down here below triple B, so double B and below, and anything above that is rated as is called investment grade. And just to be very clear, so high yield bonds today are the same as junk bonds in the past. We just decided that as an industry, it sounds better to call them high yield bonds. So when we are deciding whether to buy a bond, we will take note of what the rating agencies have to say, but then it is very important that we understand those credit risks and we form our own view. So to give you some idea of the types of companies that we invest in, here is a very small selection of high yield bond issuers, names that you may be familiar with, which are in the portfolio. So from high quality issuers like Tesco, which was actually upgraded back into investment grade last year, to companies like Merlin, the operator of Legoland, which is clearly having a tough time right now. And then a company like Ford, which was recently downgraded from investment grade back into high yield during this crisis. So, for example, I can buy a bond from Virgin Media, the UK cable TV company, which has a yield of 5.4% until 2029, whereas Ford, which has suffered that real fall from grace during this crisis, printed a bond just a few weeks ago with a coupon of 9.65% for a 10-year maturity. And I don't think anyone would disagree that over 9%, that is a very attractive level of income. But clearly there are risks even in investing in Ford these days. And to give you an example of those risks within the high yield market, manifesting themselves right now during this crisis. Just last week, Hertz, the rental car company, filed for bankruptcy in the US, and Hertz is a high yield bond issuer. Hertz has clearly been a major casualty during the crisis, as you can imagine, and the company issued a bond only in November 2019 with an attractive looking coupon of 6%. But the owners of that bond, and this is a $900 million bond, so almost $1 billion, the owners of that bond will never receive a coupon payment. because the company has defaulted. So clearly that wasn't the investment that they were making in November, and no one could have foreseen what has happened. But Hertz really highlights the fact that companies do go bankrupt and that bonds can default. But as high yield fund managers, there are ways that we can manage risks like that. And the first is we have a team of very experienced credit analysts who spend each day reassessing the credit risks of the companies that we invest in. And our view on Hertz was that the company did have heightened credit risks before the crisis. And so we felt that 6% coupon was insufficient compensation for those risks, so we didn't buy those bonds. Now, as a high yield fund manager, a high yield bond fund manager, it's very important to remain humble because there is always another Hertz just around the corner. And defaults, unfortunately, do come with the territory when investing in the high yield bond market. So the second way that we manage that credit risk and also that default risk is a very simple principle. It's through diversification. And by that, I mean that the two investment trusts that we own, bonds, within the two investment trusts, we own bonds from well over 100 different companies. So that when we do have a Hertz in the portfolio, the damage is mitigated somewhat. And you may be thinking, well, that's a bit wimpy. You're a fund manager. Where's your conviction as a fund manager? If you like a bond, why shouldn't you have a bigger holding? But that really is where there is a very key difference between a bond portfolio and an equity portfolio. And the difference really is that when I buy a bond, my upside is the coupon and then the potential for some capital gains. But those capital gains will be very different to an equity, where the price in theory has uncapped upside. So it is a different return profile between a bond and an equity. So an equity portfolio can better afford to have a Hertz that goes wrong because those losses can be recouped from another holding that does rally. And that really is the key difference between the two and why it's important to avoid over concentration within a high yield portfolio, in my opinion. So high yield bonds do offer decent income, but the quid pro quo is that there are credit risks associated with that. And if you are going to invest in the high yield bond market, then it's very important that you understand those credit risks. And the high yield bond market is very difficult to access for a retail investor. So if you are going to invest, then you need to ask a high yield bond fund manager a key question. How do you manage that credit risk? And within my team, the focus is really on those two pillars. So thorough credit analysis and then diversifying risk across as many different companies as possible. So moving on to the market. And this is the chart, this is the yield, sorry, of the European High Yield Bond Index since 2015. And you can see the impact of the crisis. So this extremely sharp jump in yields on the right-hand side of this chart, and then followed by this fairly rapid, at least partial recovery during April. And of course, that recovery was driven by the sheer scale and speed at which central banks reacted to the coronavirus crisis. So the yield on the index hit 8.5%, and today we are back down at a level of 5.9%. So the last few years, and you can see this in the chart, the last few years in the high yield bond market were dominated by low yields. And you have to look back really to late 2015 for the last time that we saw some attractive yield in the high yield market. And if you had heard me present over the past 4 or 5 years, I would have been bemoaning low yields. And why was that so important? Well, I've spoken about the credit risks of investing, and the yield, as you can see in this chart, the yield is the compensation that an investor receives for taking those risks. So very simply, is the yield enough? Is it high enough to compensate us for those risks? And in a world of generally low yields, we would often come to the conclusion that no, the yield was not enough, and so we would not invest in a bond. And that has changed today. There is more yield, but clearly there's also more credit risk. and we now have a recessionary backdrop to navigate. So generally speaking, the high yield bond market, I would say today, is doing a better job of pricing credit risk than had been the case prior to the crisis. And if we can navigate this more challenging economic backdrop, which we refer to as the fundamentals, then this is a good opportunity for us to be able to find more income than we have been able to for some time. And to give you an idea as to how I manage the two trusts with that focus on what we call valuations. So when those yields were at those very low levels at the end of 2019, our view was that generally many bonds were not offering sufficient yield compensation. And so we naturally shifted to a more cautious positioning at the end of 2019. And of course, we had no idea what was going to happen next, but that more cautious approach did set us up very well to be able to handle this crisis. So let's move on to the next page, a couple of examples of bonds and how they have behaved during this recent period that we've had. And these are price charts because I think it is important to understand the kind of price volatility that can hit high yield bond markets when we have periods like we've just had. And on the left, this is Ziggo, which is the largest cable TV operator in the Netherlands. It is a stable business. It's the type of business that a bond fund manager likes. This bond was issued in February of this year, just before the crisis began to unfold. And within a couple of weeks, they were trading at a price of 75. So bonds are typically issued at a price of 100. So that represented a 25% capital loss. And what we were seeing in March was obviously a huge amount of uncertainty around the pandemic. But in the higher bond market, that was compounded by a lack of liquidity. And that led to a very dysfunctional bond market during March. And by that, I mean that quality companies like Ziggo did see their bonds trade at prices that were more reflective of those issues around markets not functioning fully and properly than I think they were reflective of the impact of the pandemic itself. So during March, that did give us some very good opportunities to buy cheap bonds from good companies like Ziggo, like these Ziggo bonds. And then you can see what happened in this price chart is this rapid turnaround because of central banks. So the huge stimulus that central banks have put into the markets, and indeed the participation directly into bond markets, those bonds have recovered to a price close to 95. So that's a capital gain of over 25%. So I think the message from this chart for Ziggo is really that central banks are back in the game. And this time they are back in even bigger size. And I'm sure everyone knows that. And whether you agree with them being there or not, it is supportive for bond markets. And we refer to that as providing some technical support to the market right now. So the second example on this page, Ford, and this is an example of how the bond market has had to reprice a bond as the credit quality of a company has deteriorated. So this bond was issued in November last year with a fairly measly coupon of 2.33%. Today, it trades at a yield of 5.4%. To get to that higher yield, the bond price has fallen by almost 20 points. Now, the beauty of a bond is that assuming Ford is able to repay this bond in 2025, it will rise in price back up to a price of 100 or par when it matures. That's not much compensation for a holder who is currently sitting on a 20% loss, but for an investor who buys this bond today, and importantly, of course, believes that the yield is appropriate today for the credit risks, that is the kind of return profile that you can expect to make. And again, I think this highlights why it is so important for us to understand the credit risks of a company, and then to make sure that we do our best to only invest when we believe the yield offers appropriate compensation for that. So moving on, the default outlook, and it is very important to talk about the default environment when talking about high yield bonds. And hopefully I've explained our approach to credit risk, but the worst outcome for us really when we're investing is to buy a bond when it is issued and for it to then default on us. Maybe not as quick as Hertz, but for us to have a Hertz in the portfolio. And Moody's is a rating agency, one of the credit rating agencies, and they provide an outlook for their expectations of the default environment, of the default rate, sorry. And you can see, as you would imagine, with that recessionary backdrop, default rates are expected to rise. Now, these are obviously forecasts, which is always a mug's game, but the direction of travel is higher. And so you can see that is a real contrast to what the market has experienced for the past decade. So even with unprecedented central bank and fiscal interventions today, defaults are still expected to rise. And our job as fund managers and credit analysts is to navigate our way through that environment as best as we can. And good credit analysis and diversification, again, will be the key pillars to that. So the high yield bond market today does have more yield, and that's good, and we can invest in that, but also clearly more credit risks because the fundamentals are that we have a recessionary backdrop. On the other hand, we do also have central banks offering decent support to markets, and whether we like it or not, we need to be cognizant of that. So finally, finishing on our two investment trusts, I've spoken about the importance of diversification, and you can see on this chart this slide the number of issuers or companies that both invest in. So it's actually 135 and 140. So well over that 100 figure that I mentioned earlier. And they are both managed as income products with attractive dividend yields of 7.5% and 5.9%. And the consistency of those dividends is very important with our view. So for several years, both have paid a consistent dividend. We express that in pence, so not as a percent, but in pence. So that's 5 pence per annum for IPE. We have paid that consistently for several years. And likewise, 10 pence per annum has been paid consistently for City Merchants for several years. And it's very important, we think, that shareholders have been able to rely on that certainty around the dividend for quite some time now. The key difference between the two is the dividend target. So a higher dividend target at IPE, as you can see, and we achieved that higher dividend level by using a level of ongoing borrowing. Otherwise, the two portfolios are very similar in terms of their holdings, but with slightly less credit risk in Invesco Enhanced Income because of the borrowing. And then finally, I would say borrowing is a very important feature of investment trusts. It can be used very effectively to enhance returns, and it's a very important differentiator between open-ended or mutual funds. But it has to be used prudently. And at Invesco, within the team, we do have experience of doing just that. And thankfully, during this recent market volatility, we were able to do just that and certainly manage the leverage very prudently and carefully, both in a falling market and now we're in a rising market again, at least for the time being. So this is the team. Here I am looking a lot younger. But we do have a very experienced team of both fund managers and analysts. And as you can see in this chart, our senior analysts all have at least 14 years experience. And their job is to meet with the management of companies, to analyze a company's financial health, and really to understand the credit profile of the companies that we invest in. So to finish off, high yield bonds can offer decent income, but there are risks associated with that. The way that we manage those risks within the trusts is maintaining diversification and using our expertise in credit analysis. Looking ahead, that expertise will be even more important than ever in navigating what is clearly now a more challenging environment. And my personal view is that a lot, if not a majority of companies throughout the world, will experience some form of a decline in their credit profiles as a result of this crisis, at least in the short term and possibly slightly longer. But this is also an environment where there is much more income than has been available for some time. And that does create a good opportunity for us, not just for income, but also for capital gains from here. So hopefully I'm within my 20 minutes, and thank you for taking the time to listen.